Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Well, 2 weeks ago, I observed that we may well be starting to find out about the influence of all that stimulus money and what it might do for our markets. And last week, I removed the may well and simply observed that we are indeed now finding out. And it now looks as if everything, and I mean almost everything, is heading higher. What does this now imply for the individual FANGs? Well, let's take a look at the SVA charts. By the way, I think that the first thing you're going to see is that it is not all open field running for this group of stocks. However, before we take a closer look at these charts, I do want to say thanks for everyone who likes this video and all our subscribers. Well, here's Alphabet, and what can we say about this? It just continues to soldier higher, and I think with the breakout in the market, with the general swing up in the earnings, this stock simply, I think, heads towards its bubble price, which is $2,700. Facebook, not quite so neat. It's a little bit of a setback in the past week, but the MSG prices held well. That, of course, is 5.5 times book value. And I think that there's a very good chance that this company heads back up to its bubble price, where it's already peaked twice before, as I think you're aware. NVDA, well, we got a beautiful buy on NVIDIA in February, and well, 2 months later we're up 30%. So what do you want to do at this particular juncture? Last week we were looking at the stock. It looked as if it was maybe trying to break out, but I wouldn't have thought that it would have done that on the first pass, and in the past week it is set back a little bit. If I were holding the stock, I probably would continue because of the excellent apparent fundamentals, but many people, and including many of our trading clients, may well have taken their profits. 30% in 2 months is a good rate of gain. Microsoft, well, interestingly enough, Microsoft has just been kind of riding its HB2 price. That's 12 times book value. And of course, the slope of those lines tells you how fast the balance sheet is growing. And in the past year, which I've shown here, the balance sheet has grown at a rate of about 18%. So the company has delivered steady gains, nothing splashy, nothing spectacular, but steady gains over the past year. As you know, I don't particularly like the stock because that trading is what I call sloppy trading, but nonetheless, you know, if you're holding, as long as it holds tight there within the at the HB2, then good enough. And perhaps with a good market, maybe the stock will lift off from here and get up to its HB3. I'm not counting on it, but nonetheless, maybe it will. Amazon, after giving us a sell back in February and breaking down below its HB3, kind of muddled along, and very, very recently, with the market strength, has moved up back to its HB3. Hasn't been able to break out yet. So until I get a breakout, and in fact a confirmed breakout, as far as I'm concerned, Amazon would still be in the I'm not certain, but I'm probably not holding it category. Netflix. Well, you know what I feel about Netflix and have felt for a very, very long time. The weight of competition is on this company. However, after a sell signal, the stock moved down to close to its HB3. That would be 16 times its book value. and has been just kind of riding along there. And it looked maybe in the last couple of weeks as if it was kind of lifting off. However, the earnings results that this company had were not exactly scintillating, whatever people might have said, and the stock has set back abruptly to and just a little bit below its HB3 price. I am now on high alert for this company. And finally, Apple. Hard to know what to say about Apple right now. We need a new balance sheet in order to be able to make a decision about the stock. We did have a sell on the company a little while ago when it broke below its HB5. And as far as I'm concerned, that would be the condition that I would consider the shares to be in. However, some people might be holding the company, and well, we'll talk about what to do in a moment. Anyway, in summary, first, my favorite FANG, Alphabet, had given us a clear buy signal for breaking out over its mid-super growth price, that's 5.5 times book, and made a typical breakout pullback for a powerful confirmation of that signal. I expect that it is now moving towards its bubble price, that's 7.4 times book, and that would still be a nice 17% gain from here, but we'll have to wait and see what it happens when it gets there. In the distant past, this stock has been much higher. Facebook is heading towards its bubble price, again 7.4 times book, and the stock's all-time high. Last seen in August of 2020 and July of 2018. That would be a gain of 20%, and frankly, right now is all that I would expect from Facebook. I have observed that I like these two stocks insofar as they are the two value stocks in an otherwise extremely valued sector, and I would cheerfully own both of them on this basis alone. Now, NVDA, a bit of a poser. I've said several times that after the buy at its HB3, it should be able to carry to its HB4, that's 20 times book, but after that, things are less clear. Well, we got to my trading target. Last week, the stock looked as if it might try to burst out, although it hadn't yet. This week, the stock slipped below the HB4 price. Not really surprising, I suppose, although the industry dynamics are still there for a larger up move. I guess I would hold the stock and hold my breath at the same time and hope that the shares can give us a confirmed breakout. I'm going to stop right here, however, and observe that for users of SVA, NVIDIA has been a picture-perfect stock, a dead perfectly off its low, its HB3, and a dead perfect move to its next higher breakpoint. I have many active trader clients who would not hesitate for a second to grab their profits here. They might buy in again if the stock were to stage a confirmed breakout here, but otherwise they would look for another trading candidate, which is a little more certain. That's the nice thing about a service that tracks nearly 3,000 stocks. There's always something to do, and you don't have to push your luck, as now would be the case with NVIDIA. As far as Microsoft is concerned, it's been trading in what I call a sloppy trading pattern. Now, if you just held the shares for the past year, they've ridden their HB2 price to book of 10, and the balance sheet growth for the past 12 months has been 18%, so you'd have done okay. Not great, but not bad. If it could go the next mile and really break out here, we could see a 25% gain from here to the next highest breakpoint level. You know, I don't really like these kinds of patterns, but as the market is with me, I'd hold the stock. And now for the laggards. First is Amazon. Last week, I asked, is Amazon back in business again and about to break out over its HB3 price at 16 times book? It's close, but we will still have to wait and see if we get a confirmation of a real breakout, which could carry to the next breakpoint. If we do, by the way, the upside measure would be plus 28% from here. Given its senior portfolio position among the FANGs, I could certainly see that this is a possibility. Right now, it's close, but close is not a confirmed breakout. So watch this stock closely because it is right there. And remember, I would only act if a breakout, which we have not seen yet, can take place and be confirmed. Netflix continues to be what I called a reluctant participant in the current market rally and may now becoming actively hostile to it. Now, the company beat earnings expectations for the most recent quarter, to which I would add, of course they did. If I were the CEO of a company, I would fire the entire investor relations department of my company if we failed to beat expectations. Their job is to manipulate those earnings forecasts so there will be an earnings beat. And truth to be told, 85% of S&P companies are beating forecasts. This, however, is hardly a sign of strong economic growth, as much as evidence of broad-based information manipulation. Although the Netflix fans have tried to beat the drum and wave the flag, nonetheless, as I have warned repeatedly, subscriber growth continues to fade, and the shares have now suffered a sharp setback, which has carried the stock down to and now very slightly below its HB3 price. By the way, that's with the fresh balance sheet now in our database. My concerns, which I have expressed here virtually every week for months now, about slowing growth and intensifying competition now appears to being realized. There's only one question for an investor in this stock right now. Is the stock price going to scramble back on side? And is the HB3 price therefore going to hold? Or is it all over? Stay tuned and maybe you'll get a chance to go short. That leaves me with Apple. And without a revised balance sheet, it's impossible to see what the effects of the recent buybacks have been on the structural prices which govern our own strategy. For now, without any sort of signal, I cannot render any sort of useful opinion here. We expect a quarterly report from Apple very shortly, and then I can fill in the blanks. Parenthetically, I may not like what's going on with Apple and its balance sheet, but I am not paid to like what someone else does with their balance sheet or anything else. I am paid to draw an investment conclusion for what I see and help our clients do well. By the way, if I held a stock, I would probably continue holding as the market is with me. If I did not hold the shares, I would be perfectly comfortable with waiting to see what has actually transpired. Now, what should we take away from the past week? First, as they say, a rising tide lifts all boats. How much of a rising tide is implied by our SVA metrics? Well, I remind you what I said last week. If the S&P can tack on enough to take it to its next major breakpoint, that would mean an upside target of roughly 5,000 for that index, or roughly 18 to 20% higher than today. What I am telling you is that our SVA metrics are much more optimistic than the average portfolio strategist. Second, the FANGs are now definitely market followers. They're not leaders anymore. When I was looking at the SBA measured upside potential for the FANGs, they're not really promising any more than the overall market. And it is the market which is pulling them higher, not the FANGs, which are leading the market. Third, of the 7 FANGs that we are tracking for this special video, I reiterate that it's the 2 cheapest ones, Facebook and Alphabet, which would appear to offer the safest prospects for investors. Anyway, for now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday. Until then, please, everyone, stay safe. This pandemic is not over yet.